Hello everyone. So in today's video we're going to discuss a very important topic in financial markets, that is we're going to understand what are derivatives. Specifically we're going to understand the concept of forwards and futures in today's video. In the next video we'll also talk about what are options. So let's get started and let's take a simple example to understand the concept of what are derivatives. So let's say there is a jewelry manufacturer, and this jewelry manufacturer requires 10 kilograms of gold after 3 months. So he requires 10 kilograms of gold after 3 months. Currently the current price of gold is trading at 10,000 rupees per gram. Now this jewelry manufacturer in 3 months time anticipates that the price of gold is going to rise. So he anticipates that the price of gold is going to rise and he would be happy if he can get gold at this price after 3 months. So let's say he enters into a contract with a trader and a trader agrees to provide gold after 3 months at 10,000 rupees as the rate is right now. So you could have a jewelry manufacturer entering into a contract, and through that contract he'll be assured that after 3 months he will get gold at 10,000 rupees per gram so that he can carry on with his business activities. Similarly, you could have, let's say, a farmer who's going to harvest wheat in the future and he anticipates that the price of wheat could fall because there could be a surplus in the market once there is harvest. Similarly, on the other hand, you could have, say, a mill owner who fears that there is going to be a rise in price of wheat in the after the harvest. So you could have both these parties. So you could have the farmer and the mill owner who together sign a contract at a mutually agreed price, and through this contract the farmer can be assured that he'll be able to sell the wheat at the price he wants, and the mill owner can be assured that he will get wheat to process further at the price he wants. So contracts such as this, which the gold jewelry manufacturer or out here the farmer and the mill owner are entering, are called as derivatives. So essentially a derivative is a contract whose value depends on the price of an underlying asset. So an underlying asset could be anything. So you could have agricultural commodities, you could have precious metals, say such as gold or silver we talked about. You could even have foreign currency as the underlying asset, or you could even have things such as crude oil and several other commodities. So essentially a derivative is a contract which is signed between two parties and the value of that contract is derived from the value of the underlying asset. So like we saw in the examples we talked right now, the contract which is signed between the jewelry manufacturer and the trader, that contract is essentially a piece of paper, but that piece of paper derives its value because that contract is a contract to trade gold in the future between these two parties at a specified rate. Correspondingly, the contract which is going to be signed between the farmer as well as a trader is going to be a contract to buy and sell wheat at a mutually agreed price. So these are what are called as derivatives contracts. So now the reason why derivative contracts are used is that they provide multiple benefits, and we're going to talk about 3 key benefits which derivative contracts provide. The first benefit is that derivative contracts can be used for hedging. That is, derivative contracts can be used as a means to protect against adverse price movements. So let's say wheat is selling right now in the market at 2500 rupees per quintal. Now let's say in the future after harvest, the farmer anticipates that because there's going to be an excess of supply, the price could drop to say 2000 rupees per quintal. So what a farmer can do is that a farmer can enter into a contract that once the wheat is harvested, he can sell that wheat for the price of 2500 rupees per quintal. So price of wheat in contract. So what is happening out here is that by locking in the price which he can sell the wheat in the future, he's protecting himself, or he's providing a sort of insurance for himself that regardless of what the price movement is going to be in the future, he'll be able to sell at the price he wants and correspondingly make a profit. So thereby derivatives can be used to hedge risk, that is protect one against adverse price movements. The second benefit which derivatives provide is that they can be used for speculation. So by speculation we mean that they can be used to benefit from fluctuation in prices. So price movement fluctuation. So derivatives can be used to benefit traders or investors, say, from benefit from these fluctuation in price movement. So let's say currently you have $1 which is trading for 85 rupees. Now there is a speculator in the market who feels that in the future the price of rupee is going to depreciate. So he anticipates that after 3 months the value of rupee is going to depreciate against the dollar, and he enters into a contract, say with another trader, to buy dollars after 3 months, and he agrees to buy dollars at the rate of 85 rupees per dollar. Now you can have two scenarios after 3 months. So let's say the first scenario after 3 months is that $1 is now equivalent to 88 rupees. So now in this situation, what this speculator can do is that after he gets the dollars by buying dollars for 85 rupees, he can sell that dollars and get 88 rupees back. So he can basically make a profit of 3 rupees because he got to buy dollars at 85 rupees per dollar. So he will have a profit in this scenario. The second scenario could be the rupee appreciates and $1 becomes equivalent to 83 rupees. Now in this situation, if this speculator were to sell the dollars and buy rupee in the market, he will have a loss of 2 rupees. So what is happening out here is that out here the speculator or the trader is using a derivative contract to buy dollars, not because he needs to import some certain commodities, but he wants to do it because he is betting on his knowledge regarding what the fluctuations are going to be in price movement or the exchange rate, and he wants to profit from that. So that is the second benefit which derivatives provide, that is they help investors, traders speculate and hence benefit from fluctuations in prices of different commodities in the market. The third benefit which derivatives provide is that they help in arbitrage. Arbitrage is a process where you have a trader buying a commodity at a cheaper price in a market, at a cheaper price in one market, and simultaneously selling that at a higher price in another market. So derivative contracts can essentially be used to allow traders or speculators to benefit from price differences in two markets. So that's the third benefit which derivatives provide. Now if you talk about derivatives in general, derivatives in India are regulated by SEBI, which is the capital market regulator in India. Now we know that the money market regulator is RBI. So if we talk specifically about derivatives, which are capital market instruments, they are regulated by SEBI, that is the Securities and Exchange Board of India. Now the two most common type of derivatives which we're going to talk in today's video for the remainder of video are your forward contracts and your future contracts. So let's talk about these two specific types of derivatives. So if you talk about what a forward contract is, so a forward contract is essentially an agreement between two parties. So two parties enter into an agreement to buy or sell a particular commodity in the future at a predetermined price. So you have a contract which two parties sign amongst themselves, and they sign that contract whereby these two parties agree that in the future at a certain point of time or at a certain date they will buy one commodity and the other party will sell that commodity, and they will do that at a specified price. Now the thing about forward contracts is that they are privately negotiated. That is, you don't have any stock exchange such as Bombay Stock Exchange or National Stock Exchange which is involved. So these contracts are signed directly between the two parties. That's why they are also called as over-the-counter contracts. That is, they are traded in the over-the-counter market. That is, they traded outside of the stock exchange. Now because these are privately negotiated contracts, so these contracts can be customized. So you can have, let's say, a mill owner entering into a contract with a farmer, and he can be like that, I want 750 kgs of rice of a specific variety, and I want this after say 4 months, and I want it at a specific warehouse, say which I have in Lucknow. So what is happening out here is that depending on the needs of the two parties can privately negotiate and enter into a contract which is convenient for both of the parties. So out here there is no exchange which is involved. So while that is a benefit these contracts provide, they also come with a risk that because there is no exchange involved, there is a possibility, or there's a high possibility that one party may fail to honor the contract if it becomes less favorable for that party. So there is a significant counterparty risk. Now to illustrate, taking an early example, given that wheat was trading at 2500 rupees a quintal, and let's say a mill owner had entered into a contract where he was assured that after 4 months he will get wheat at that price. Now let's say if the price of the wheat after harvest rose to 3000 rupees per quintal, and if this was a forward contract, that is a contract negotiated between the two parties, then in this situation there is a high possibility that the farmer could be tempted to back out and not honor this contract. So that is the risk which forward contracts have. Now an alternate form of contract is your future contract. So this contract is similar to a forward contract in the sense that it is an agreement between two parties where one party is obligated to buy a commodity and the other party is obligated to sell that commodity in the future at a specified price. However, unlike forward contracts, these contracts are standardized contracts. That is, they cannot be negotiated between two parties as per their own requirements. So these are specified and standardized contracts, and they are not customizable. So for example, you could have a contract which says that you can buy 1000 kgs of rice and not 750. The delivery time is 3 months and not 4 months as you want, and it talks about a certain type of rice and not the specific type you're wanting, and could be even the delivery is going to be at a certain specified warehouse and not the warehouse you were talking in, for example say your city such as Lucknow. So because these contracts are traded on the stock exchange, these are standardized contracts. These contracts are traded on stock exchanges such as the National Stock Exchange or the Bombay Stock Exchange. Also, because these are traded on stock exchanges, future contracts are regulated by SEBI. Now, if you talk about your forward contracts, they were not regulated, but your future contracts are regulated. Also, because they are traded in the stock exchange, you have something, an entity called the clearing corporation, which is responsible for ensuring that the contract gets executed. So you have clearing corporation which is responsible for ensuring that there is no counterparty risk and both the parties honor the commitment which they have agreed to in the future, and they buy and sell the article which they have decided to in the future. So that is the benefit which future contracts have over forward contracts. That is, while they are standardized contracts and they cannot be customized per the needs of the parties, these contracts ensure that the buyer is obligated to buy the asset and thereby settle the contract. On the other hand, the seller is obligated to sell the asset and thereby settle the contract. That is, no party can take undue advantage of any price movement which is not in its favor and not execute the contract. So this was the broad concept of forward and future, which are the two most common type of derivatives. In the next video, we're going to talk about a third type of derivative, which is options. So we'll talk about put and call options as well. I hope you liked this video. If you did, stay tuned and follow the channel for more concepts in regards to UPSC economics. Thank you so much for watching.